Hi everybody, this is the second video for topic 7 ACT2131. Okay, so in the first video you have been introduced to several concepts and terms. Okay, you have seen the definition of segment, responsibility centers, and then you have seen the definition for the term of traceable fixed cost and common fixed cost. So in this second video, you will see the most important aspect or part of this topic 7. In this video, you will see how to prepare income statement for segments of a business. The thing is like this. Let's say you have a business. Your business produces frozen food, and then you have two products. One is frozen cakes. Another one is frozen curry puff. So these two products can be seen as two segments of business. Two segments of your business. So one is segment for frozen cake. Another one is segment for frozen curry puff. So when you have two segments, you can prepare income statement for these two segments. You have one income statement for your business, and then the income statement for your business can be divided into two segments. One income statement for the cake and another one income statement for the curry puff, so that you can see clearly which segment makes profit, which segment is making loss or perform less than the other, so that you can improve the process and you can improve your business. Okay, let's see. In this slide, levels of segmented statements. Okay, there is a business. Weber Incorporated has two divisions. So this is an example in this slide. The company name is Weber Incorporated, and this company or business has two product, so that it has two segment or division. One product is computer and another one is television. So one company has two products, so we can say that this company has two segments. Let's look more closely at the television division income statement. Okay, there are two, so we focus on television division only. So this is the income statement for segment television. So the income statement that we use in management accounting is the contribution margin format income statement. So this income statement, the format is like this: revenue or sales minus variable costs, you will get contribution margin, and then minus fixed cost, you will get the profit or margin. In this example, for the television division, the sales is 300,000, and then the business or the segment has variable cost of goods sold 120,000, and then the business has other variable costs 30,000. So the total variable cost is 150,000. Contribution margin is the sales minus the variable cost. So the contribution margin is 150,000. The fixed cost, the traceable fixed cost here is 90,000. So the division profit or margin is 60,000. So in the green box, you can see the cost of goods sold consists of variable manufacturing costs. So fixed and variable costs are listed in separate sections. So I think you have seen this format before. I have explained to you about the contribution margin format income statement. You have to separate the variable cost, and then and another one is the fixed cost. Okay, let's see. Okay, this is the income statement again, and then you see the green box. Segment margin is television's contribution to profit. So segment margin means profit for the segment. So this business has another division, computer division. So computer division also has profit for each segment. Okay, now we are focusing on the television division. So see here, remember the definition of traceable fixed cost? Actually, the company has two segments, computer and television. Traceable fixed costs are fixed costs that can be associated with one segment. Another one is common fixed cost. You have to remember what is the common fixed cost. Okay, let's see. Now, this is the format that you have to use when you prepare a segment income statement. Okay, let's see how the television division fits into Weber Incorporated. Okay, this is the thing. The company name is Weber. So the company has an income statement. The income statement of the company is in the first column. Company income statement is sales 500,000, variable cost 230,000, and contribution margin is 270,000, and the fixed costs, there are two fixed costs there, traceable fixed cost and common fixed cost. Remember about the two types of fixed cost, traceable fixed cost and common fixed cost. Remember, traceable fixed cost related to one division. It will become zero if the division does not exist. But common fixed cost is a fixed cost that is not associated with one segment. If the segment is closed, the common fixed cost is still exists. So when you prepare income statement for segments of businesses, you cannot divide the common cost. You only can divide or calculate the traceable fixed cost. Okay, I will try to explain it in a different way. See, the income statement of the company is supposed to be sales 500,000 minus variable cost 230,000, and then the company has 270,000 contribution margin. Actually, the fixed cost of the company is 170,000 plus 25,000. So the fixed cost is actually 195,000. That's the company's fixed cost. But when you have to prepare segments income statement, in this slide, the segments are segment television and segment computer. You only can divide the fixed cost. You only can divide or allocate the traceable fixed cost only to the segments. Common fixed cost cannot be divided or allocated to segments. Remember the definition. Traceable fixed costs are fixed costs that can be associated with one segment. Common fixed costs are fixed costs that will not become zero even though segments of the business are closed down. So in the previous slide, in the video 1, the example is the salary of the CEO or president. In this, if we use the example, in this Weber, the common cost is maybe the salary of the CEO or president. If you close the television segment, the company still has to pay the salary of the CEO. or you close the computer division, still the company has to pay the salary of the CEO, which is the common cost. That's why common cost cannot be divided or allocated to the segments of the business. So always remember, when you prepare an income statement for segments reporting, you only can divide or allocate the traceable fixed cost only to the segments, but you cannot allocate or divide the common costs. See, the blue box, common cost should not be allocated to the division. This cost will remain even if one of the divisions were eliminated. So in this topic, you have to know how to prepare income statement for segments of a business. If I give you a data, and then you have to know how to prepare an income statement like this. You have to know how to prepare the company income statement, and then you have to know how to prepare the segment income statement. For example, here the television segment income statement and the computer income statement. Okay, another thing that this is easy. This is additional explanation for the income statement that you have seen in the previous slide. Traceable costs can become common costs. Fixed costs that are traceable on one segmented statement can become common if the company is divided into smaller segments. Okay, let's see how this works. Okay, this is not very difficult. So now, remember the company. The company's name is Weber Incorporated. So the company has two main segments: computer and television. Now we are focusing on television only. So in the previous slide, you can see the income statement for the television division. In that income statement for the segment television, you can see an amount of a number for the variable cost and fixed cost. So now, let's say the television division has two smaller divisions. There are two types of televisions: regular television segment, regular television, and big screen television. So these two also can be seen as segments. So the main segment is television division. Under the television division, there are two smaller segments: regular and big screen. And also it is possible under regular there are two segments, and big screen also two segments, but we focus on the regular and big screen first. So now, okay, so you have seen from the previous slides, you have seen the income statement for television division. So the income statement is like the one that shown in this slide. The television division, the sales is 300,000, and then variable cost is 150,000, and the fixed cost of the television division is 90,000 in the previous slide. In the previous slide, it is 90,000. But when you have to prepare or to show segments income statement under the television division, then you have to aware that the 90,000 fixed cost that you have seen in the previous slide can be divided, or it contains two types of fixed costs: traceable fixed cost and common fixed cost. Just remember the definition. The traceable fixed cost is a fixed cost that will become zero if the segments under the television are closed. The common fixed cost is the fixed cost that will not become zero even though the segments under the television divisions are closed. So always remember, when you have to prepare an income statement for a business segments, then always aware that you have to show two types of the fixed costs. Only traceable costs can be divided or allocated to different segments. Common fixed costs cannot be divided or allocated to different segments. Okay. Okay, see here the green box of the 90,000 cost directly traced to the television division. 45,000 is traceable to regular and 35,000 traceable to big screen product line. The 10,000 is common fixed cost. The remaining 10,000 cannot be traced to either the regular or big screen product lines. So for this topic, the most important thing is you have to know how to prepare an income statement for a business that has several segments. Like this, you have to know how to prepare this type of income statement. Okay. After you have prepared the income statement for several segments of a business, you will see that each segment has its own profit or margin. See here, when you prepare the segmental reporting for the television division, you will see that regular TV has a margin or profit, and the big screen TV also has a margin or profit. It means that after you have prepared the segmental reporting for the TV division, you can see the profit made by the regular segment and the big screen segment. Okay, that is the main purpose of preparing the segmental reporting. You want to see the profitability or the performance of each segment. So the segment margin is the best measure of long run profitability of a segment. It means that if you have a business, it is very important to prepare a segmental reporting for your business, because the segmental reporting or income statement for segments of business will show the performance of every segment in the business. If you do not prepare segmental reporting for your business, then you do not know the performance of every segment in your business. Like before, the example is you have a frozen food business. You prepare an income statement for your business. Yes, you can see the performance of your business, but you cannot see the performance of segments under your business. You cannot see the performance of the frozen cake segment, and also you cannot see the performance of the curry puff segment. So to know the performance of these two segments, you have to prepare the segmental reporting or the income statement for several segments of the business. Okay, this is explanation about why you cannot allocate or divide the common costs to different segments in a business. I have told you several times in the previous slide. you cannot allocate or divide common costs to different segments. You only can divide or allocate the traceable fixed cost only. These are the reasons. The 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 main point is, if you allocate the common costs to different segments in a business, then you will make, or you will see, wrong calculation for the profitability of each segment. It is not easy. It is easier for me to explain this if I have a whiteboard, because I can show you why you cannot allocate the common fixed cost to different segments. But you can see the explanation in this sample question. Okay. Okay, let's see. There is a allocation of common costs here. If you follow or go through this quick check or sample question here, you will get an idea about why you should not allocate common costs to different segments. I hope you will read this sample question, and you will see why. A very good example. You have to spend some time to read this and try to understand why you cannot allocate common costs to different segments in a business. If you allocate the common cost to different segments, there will be a problem. You will make wrong conclusion about the performance of each segment. Sometimes when you allocate the common cost, a segment that is profitable becomes unprofitable. So you will make wrong conclusion about the segment. Okay, this is the point that I have trying to say. Allocating common fixed costs to the segment those fixed cost support is a recipe for disaster. If you allocate the common fixed cost to different segments in a business, you will make wrong conclusion about the performance of the segment. Okay, thank you very much. This is the end of this topic. So you can communicate with me in the comment section. If you see there are more slides in these notes, you can you don't have to worry about the slides. You stop here. Thank you very much.